Hi, everybody. It's Dr. Robinson. This is the November 3rd, 2022 update of the Money Masters Investment Club. I want to remind you guys, I traveled to San Francisco late last week, and last week I inadvertently failed to update my financials or our financials, so I couldn't provide any numbers. So therefore, I wasn't able to do a meeting last week. I'm sorry about that. This week's totals will include the net numbers for both weeks, though, so I'll get you up to date on what happened over the last couple of weeks. So having said that, let's look at our itinerary. Our itinerary is going to be what it is normally. We're going to do our financials real quick, and then we're going to look at, I think I've got 7 or 8 slides I want to look at in terms of a market update. A lot has happened over the last few days, especially, but there's been a bunch happening over the last couple of weeks, so we'll talk about that in just a bit. Let's first take a look at the financials. Starting NAV from October 27, 2022, 2185. Now, if you remember from 2 weeks ago, that's actually a loss from the previous week. So we last week we lost a total of 42 cents. I had a really tough week last week. Mostly it was just 2 trades that got away from me, and the losses were pretty big on those 2 trades. But we have made it up this week. We're up 68 cents for the week, so we're kind of back where we started, a little further ahead. But so we did gain 68 cents this week. So our ending NAV this week, 22.53. When you go from the 21.85 up to the 22.53, the 68-cent gain comes out to a gain this week of 3%. So we had roughly about a 3% loss last week, a 3% gain this week. A little, not quite the exact numbers, but give or take. So we're kind of right back where we started from 2 weeks ago. But I think we've got the a solution to our problem with the losses there. So in any event, pretty good week this week. Next week, I assume we're going to have some pretty good numbers. I had a really good day today, and I'm hoping to have another really good day tomorrow, which, of course, tomorrow's numbers will be into next week's numbers. But in any event, those are that's the performance for the last week or so, actually 2 weeks. We do have an unrealized gain continuing in a strangle that we're holding, so our strangle still remains positive. The calls have come down a little bit. Our calls were a little higher, but the last couple of days have been treacherous on calls. So our calls are still in the money. The ITM stands for in the money. They're in the money by 68 cents. The puts are really in the money by $1.97, so almost $2 on the puts. We have a net unrealized gain right now of 155,847. So almost $156,000 of profits there. Remember, I can't add those to the books right now because they're unrealized. We're still holding the position. So that doesn't reflect anything in our net asset value. Only when we exit the position will that be realized. So we're still holding tight there. I'll tell you, I think that the puts are going to start doing a little bit better or continue to do well. I think the calls are going to struggle. I'm a little on the fence on it, though. I'll tell you why in just a moment. But we're in a pretty good position. We're pretty neutral on the deltas on both positions. So whether one works better than the other, it's just going to be icing on the cake to us. So at the end of the day, pretty good position right now on the strangle. So we've been watching interest rates over the last several months, I think since about February of this year. And of course, they've been consistently climbing. The rates as of right now, the 1 year is up 29 basis points from 2 weeks ago. Now remember, this is from 2 weeks ago since I didn't do a meeting last week. 21.6 basis points from 2 weeks ago on the 2 year, almost 14 and a half basis points on the 3 year. 10.7 on the 5, 11.2 on the 7 year, 14.7 on the 10 year. The 10 year continues to climb. We're not as high as we had been. Remember, a few weeks ago, we'd gotten up to about 425 on the 10 year, but we are getting back up there. It had started coming down a little bit, had come all the way down to 4.7, I think it was 3 weeks ago or so, but it's back on the climb. So we expect to see that decline even further from here. 21.2 basis points on the 30 year rather. So and you can see the 6-month T-bill, almost 4.6% yield on that 6-month T-bill. A lot of people are buying that T-bill. There's a lot of people buying the I-bond as well. If you know anything about that, that's the inflation adjusted bond. That's paying almost 6% or a little over 6% right now. I think 6.2. It's come down a little bit from the 9, but we're starting to see some real increases in these interest rates, guys. This is not good for the economy. It's good for bond investors, even though the inflation rate is still higher. So we're still seeing, bond investors are still losing money in terms of buying power in the bond market, but they do have a positive rate of return. And remember, while interest rates stay this high, there's going to be a lot of investors, especially the older folks, a lot of investors who are not going to be interested in stocks. Remember, when yields are low, investors look for yield. And sometimes if you can't get yield in the bond market, your only choice really is to go into dividend stocks. So you'll end up buying dividend stocks. And of course, when you have more buyers of something, the price of that thing goes up. So there's not going to be a lot of investors. The older folks are not going to be interested too much in dividend stocks, mostly because stocks keep going down right now, but also because you can get a better yield in the bond market, which is guaranteed. Remember, these are backed by the full faith and credit of the United States government. So there's no way to lose any money unless, of course, you sell uh, before the bond matures. But with yields this high, there's no reason to take a long-term bond. You can do a 6-month bond right now and get 4.6%. So there's no reason to buy a 10-year bond or a 30-year bond and try to make a yield or a better yield with a longer duration, because at the end of the day, right now, the yields are better on the shorter term stuff than they are in the long term. So I don't expect it to change anytime soon. There's just not going to be any money going into dividend stocks right now. So dividend stocks are going to struggle here for the time being. On the upper right, or I'm sorry, the upper left-hand corner, you can see our mortgage rates. We have a 30-year fixed rate 7.23, 15-year rate 6.45. I think this is going even higher. I think in the next month or so, we're going to see rates piercing 8%. I'll tell you why in just a bit, but I think it's a very real possibility. And again, it's going to decimate the real estate market. It's already being hurt pretty hard. Real estate sales are down more than 60% from year over year. So I expect to see that to continue. It's just the rates being this high, it's scaring off everybody in the marketplace. And it doesn't make any sense from anybody at in any economic way to take on a mortgage at almost 7.5% or 7.25%. That's just way too high. In any event, that's our interest rate stuff for the last couple of weeks. Actually, let's just call it the last week or so. But we are starting to see or continuing to see an increase in interest rates. I wanted to show you this. Remember, the Fed had their meeting yesterday where they announced an increase in the Fed funds rate of 75 basis points. That's 0.75%. And the market had priced that in. The market kind of knew that we were going to get a 75 basis points increase. What the market had been hoping, and we had seen it in the market, by the way, in the action of the market. The market over the last couple of weeks has been on a rally. And again, I've been telling you guys this, I think this is our fourth rally. And each time I keep telling you guys that I don't think this rally is going to hold, simply because the stock market is convinced the Fed is either going to stop or reduce the increases in interest rates. Now, I'm okay with that in theory. I do think that in January we're going to get another increase in interest rates, but I don't expect it to be 75 basis points. I think 50 basis points is priced in. But a lot of people assume that if the Fed does another 50 basis points in December, that come January, February, when they have their next meeting, that we might not see any increase, or if we do, it might be as little as 25 basis points. I think that's still wrong. And I think it for a lot of reasons, mostly because no matter how much the Fed has done on interest rate right now, we're not seeing the move in the inflation rates. The inflation rates just are not coming down. Rent inflation is still at all-time highs. Food inflation is still there. Oil prices are fluctuating a little bit. The oil was down a little bit today, but I think long term, and I'm starting to think that we might want to get back in, if we're going to get back into stocks, we might want to start looking at some energy stocks. I think oil is going back to 115 here in the next, probably by the end of the year. And I say that because as the year gets on and things get colder, people in the Northeast who need heating oil, Europe, of course, needs lots of heating oil. Um, that's going to drive up prices. So I do think that we're going to start to see an increase in oil prices again coming on fairly quickly. The dollar right now being so high, it's kind of playing havoc with the oil prices a little bit. Remember, as the dollar goes up, oil comes down a little bit, but to kind of offset those prices, because remember, whenever you buy oil, you have to buy oil in U.S. dollars. So to offset some of these increases, the dollar does, or when the dollar goes up, oil prices slide a little bit. We saw that again today, but I don't think that's going to be a long-term solution. The dollar can't continue going up too much more. I've got a slide on the dollar. We'll show you that in just a bit. But at the end of the day, I think we're going to see oil at maybe 115 by the end of the year. It might be a little lower than that, but I think that's a ballpark figure for where economic analysis says that it probably will go. Having said that, um, the market keeps driving up, or the market participants keep driving up the market. The bulls have, the last 3 weeks, the bulls, I think we went 3 weeks without a day loss, without a loss a single day. And the bulls were just convinced the Fed is going to reduce the interest rates, or reduce at the very least the increases in the interest rates. Instead of using 75 basis points, use a 50, maybe 25, and then maybe by the first of next year, not do any. I think that's wrong. The Fed has made it clear until they can get inflation under control, the interest rates are going to continue to go up. This chart actually kind of shows it. So most market participants had been expecting a terminal rate on the Fed funds rate of between 4.75 and maybe at the top line 5. The Fed has come out and said the top line could be closer to, say, 5.5. Now, if you think about that, remember the things I've told you. A 10-year bond, for example, is usually 3 points. Mortgage rates rather are 3 points above a 10-year. If you take the Fed funds rate up to, say, 5.5, that means the 10-year bond is probably going to be close to 6, and that means mortgage rates are going to be close to 9. So at the end of the day, this is much bigger, much higher than people were anticipating, and by that math, the market has got to continue coming down. So the market participants who had been thinking that the bulls were trying to push this market higher, thinking we were free and clear that the Fed was going to pivot off of interest rate increases right now, I think that's kind of gone by the wayside. Now, I could be wrong on that, and I'll show you why in just a moment. The market is really optimistic right now, and I'm not sure why. You couldn't tell from the last couple of days of trading, but there is something out there that was kind of an abnormal chart that kind of tells me that there's still not a lot of fear in the market. And I'll show you that in just a moment. But I do think that the Fed terminal rate is going to be closer to 5.5, and dare I say close to 6. I don't know if it'll go that high. I think if the Fed takes the terminal rate up that high, any recession that we have, and we are officially out of a recession, by the way, and I didn't show you the chart on that, but the third quarter did have positive GDP. But if we do go back into recession early next year, if the Fed pushes the Fed funds rate up to, say, 6 or so, or close to 6, that recession that I've been telling you that might be long but not very deep could be very deep and long. So I think the Fed's going to have to rein it in at some point. When that is, I don't know. You would think that by raising interest rates from where we were in the spring of this year to now, by as much as we have, I think they've gone up 350 basis points just on the Fed funds rate. You would think that that would have had an impact on inflation. And while I'm not saying it hasn't had any impact, the impact has been relatively slight. And it's only been in certain areas. So I'm not entirely convinced that they will allow it to get up that high, but if they do, that could be really bad for the economy. But the red line on that line, or on this chart, by the way, is where the Fed funds terminal rate is expected to be, where the Fed kind of expects it to be. The green line is where investors have been thinking that it's going to be. So the market has been pricing in. You can see maybe between 4.9 and 5% on the Fed funds rate, the terminal rate. But based on what the Fed has said, that rate's probably closer to right now at 5.2. We've got it at 5.2, but it might be again climbing. We still got a couple of months to go for the end of the year, and then maybe into the first quarter of next year. So there's plenty of time for that rate to go from 5.2 to maybe 5.5 or even higher than that. But I think that's the disconnect between the market and the Fed right now. And for that reason, I think that the market has continued to see a lot of volatility where the investors are trying to push the market higher. The bulls are trying to like crazy to push the market higher, but right now they are fighting the Fed man to man. It's kind of eyeball to eyeball. They're fighting it tooth and nail, and ultimately they're going to lose that fight. If Jerome Powell has any say in this, his comments were very clear. He's going to take it higher than anybody thought, and for longer than anyone thought. So a lot of people actually assumed there was a lot of bond investors that I read about, and they're kind of convinced that interest rates will have to start going down, not just not increasing as much, actually have to start going down by maybe March of next year. I don't see it. Again, I don't have a crystal ball, so I can't see what happens in March. But with everything the way it is right now, I don't see any decreases in interest rates coming anytime soon. I don't even know if we'll see it in 2023 at all. It might be until 2024 before we see any kind of decreases in interest rates. But again, we'll play it by ear and see what happens. But that's what I'm looking at. This next slide, and this is the reason I kind of told you that I'm kind of suspicious about the market right now. There is a lot of optimism in the market, despite the fact that there's a lot of headwinds in the market. This is the VIX, and you'll notice, and this is an inverted version of the VIX, by the way. Now, if you remember in my talks on the VIX is inverse to the market. So when the market goes up, the VIX goes down. Remember, the VIX is the volatility index. So it tells us how much volatility or how much fear, if you will, is in the market. So when the market goes up, if the stock market goes up, the Dow, the S&P, the NASDAQ and stuff, when that goes up, fear goes down because that's what people want. That's where their IRAs and their 401ks are at. So everybody feels a little bit better when the market goes up. So the VIX goes down. And when the VIX goes down, fear goes up. So you would expect the VIX to go up when the market goes down. And yet, look what happened yesterday. And this is just from yesterday. Yesterday, the market tanked on the news from the Federal Reserve meeting. And it was just mostly the comments from the Fed, not so much what the Fed actually said. Again, we kind of knew that they were going to do a 75 basis points increase in the rates. So that was expected. What wasn't expected is his hawkish comments after the meeting or in his Q&A session. In that session, he basically said there is no pivot, not anytime soon, so the rates are going to be higher for longer. The market sold off. You can see it went all the way almost we were at 3,900. I think the market was actually at 388 on the S&P or SPY rather. That's about 3,800 on the S&P. We had come to, in the days prior to that, we'd come to about 3,900 on the S&P. That would be 390 on the SPDR. The SPDR is 10% of the overall market. And it dropped from 3,900 or roughly 3,900 in the days ahead to below 3,750. So we've seen a huge decrease. We wiped off almost 2 weeks of earnings in the stock market in a matter of minutes yesterday. And yet the VIX didn't really go up. In fact, the VIX was actually down today. It's at 2543 today. We would expect that to be higher. We would have, a couple of days ago, the VIX was at 27. And right now it's down, basically 150 basis points from when the market was actually in pretty good shape, when the market or market participants were thinking the market's going to go up and the Fed's going to be a little bit more dovish, if you will. But it didn't happen. And yet the VIX didn't go down, or I'm sorry, didn't go up. And in fact goes down. And I'm not sure why that is. I'm not sure if it's just not enough fear in the market, or if market participants really believe that at the end of the day, the Fed really can't go much higher in interest rates. So are they continuing to fight the Fed? I don't know. So that's the only kind of wrench in the works in terms of why I think the Fed's going to continue to raise rates. But the market doesn't believe that. Now we will have to act accordingly. So if the market continues to believe this, they're going to try hard to push that market up. So again, the more they try to push that market up, the lower the VIX will go. So not sure what's causing this. It's an anomaly. Never really seen it before. We've seen it from time to time, but in small situations where the market doesn't go down a lot. But when you see a market go from say 3,900 down to 3,750 in a matter of hours, or not even hours, about an hour and a half, you would expect the VIX to fly up, maybe back up into the 30s and the mid 30s and so. But Right now, it's not. It's not getting anywhere near those kinds of numbers. Um, so we'll keep watching that to see what that does. Now that does the good news on the lower VIX is it does make our options cheaper. As you guys probably know, one of the factors of in a Black-Scholes formula, that's the formula to how we calculate the value of an option. One of the factors in that is the VIX, how much volatility or how much fear there is in the market. So as fear comes down, the prices of options come down. So we will start seeing some lower prices. We did a little bit today. So we'll see lower prices on options as the VIX remains at these lower levels. But I don't expect that to last. I don't know what would cause the market not to react to what happened yesterday and today, because today we were down again on the market. So we had 2 days in a row where we're down really big, and yet the market really hasn't reacted to it in fear. But we'll watch it and see if we can come up with an explanation. Maybe it's an anomaly, but who knows? But it's a little strange. We'd expect that VIX to be coming up, and it's actually going down. So having said that, let's move to the next. This is that volatility skew I was talking about. So again, normally, and again, this is kind of related to the VIX. So when we talk about volatility, we talk about how it's skewed, how much fear there is in the market. And again, you can see that even despite what happened yesterday, the fear is coming down. And I don't know how to explain that for the moment. I would expect the fear to be going up. I would expect this to be skewing to the upside, and yet it's continuing to go to the downside. So again, that does have an effect on the VIX, as of course we just looked at that. But the skew here tells me that I don't know if the Fed just did a poor job of putting fear in the hearts of the bulls, or maybe it's just maybe the bulls do have some fear, but the bears don't care. Maybe they're complacent or something. I don't know. But at the end of the day, we're starting to see a skew to the downside on the fear. And again, that it doesn't make sense from an economic point of view. We should be seeing the volatility skewing higher, not lower. But again, right now that's good for us because it does make our options a little bit cheaper, so we can buy more with less money up front. So that's another one of those anomalous charts I wanted you to look at so you can get a good idea of what's going on in the market. Some things in the market just don't make any sense right now. This is my last chart, and this chart again kind of is basically the spot dollar or the index of the U.S. dollar. You can see it's continuing to climb. And I've been telling you for several weeks now, as the two things that happen, as interest rates go up and as the dollar strengthens, the stock market is just not going to be able to go up. And the dollar did strengthen. Now the dollar had been weakening. You can see that in the last over the last couple of weeks we had seen some weakening in the dollar. The dollar had come down. Now this is a spot index. It's not the actual dollar. The dollar right now I think is at 112.10 or something. But it is up. We had fallen to as low as 109 a couple of weeks ago. So it had been falling. And when the dollar falls, the market wants to go up. Of course, when the dollar goes up, the market tends to go down. So the dollar is going up again. So again, that long-term trend that we've been watching, when the dollar goes up and interest rates go up, the market just can't go up that much. So that's going to put a kind of a cap on how high the market can go. So if there's anything out there to try to get the dollar lower, of course, I don't know that there's anything out there to make the dollar lower. The dollar is it's kind of busting a lot of other economies up too. But as the dollar gets stronger, it just, or as interest rates get higher, it just attracts more and more people to the American dollar. So the dollar's probably going to get a little stronger. I'm hoping it doesn't get too much stronger because, again, there's a risk of some bad things down the road if it gets too high, where some other countries might get tired of the U.S. dollar going up and up and up. Because remember, they have to defend their currencies against a rising dollar. That means they have to sell U.S. dollars, and to sell those U.S. dollars, they have to either print more of their own money or do something with gold or something. So there's some different strategies they have, but they have to defend their own currencies. And if they have to defend their currencies too much, they might just get to a point where they're like, let's not use the U.S. dollar as the world's reserve currency. I don't see something like that happening anytime soon, but I just throw it out there as an alternative to a good rise. A lot of people are like, hey, it's good that the dollar's rising, but the dollar can rise, but it can get to the point where it's too expensive because that makes commodities more expensive. It makes everything more expensive. So as these interest rates go up, the Fed risks ruining other economies as well. So I bring that to your attention just for informational. But it is a big indicator of what's going on in the market. As the dollar rises, as interest rates go up, the market's going to continue to be capped at how high it can go up and how long a rally or how far a rally can go. Having said that, that's all I've got for this week. So if you have any questions, of course, like always, send me an email, send me or text me or whatever, and we'll see you next week.